Welcome back. Well, let's get some conversations going with a chemical company now. Rossari Biotech posted a mixed set of Q3 numbers. While their revenues were down 9%, margins improved by 300 basis points on a YOY basis. But the company has gone ahead and cut guidance in terms of revenues and margins as well. We have with us Mr. Sunil Chari, who is the co-founder and managing director at the company. Mr. Chari, good afternoon. Thank you so much for joining us here on CNBC TV 18. Well, you have cut the revenue guidance to 1,700 crore rupees versus 2,000 crore rupees earlier. In terms of EBITDA as well, you expect to do 230 crore rupees versus 250 crore rupees earlier. Can you tell us what went wrong? Because Q3 did see an improvement in margins, and textiles business, which was not doing so well, also saw an improvement. So what led to this guidance cut?
So one thing was our subsidiaries where we have significant exports to US and Europe. Our exports increased, but it did not increase as per what we had planned, especially because of the Ukraine war. The second thing was a softening in the raw material prices and consequent softening in the finished good prices, which was more than what we had planned. In terms of EBITDA, if you see, we did 168 crores in the first 9 months of this year on a consolidated basis, which is the highest ever EBITDA in history of Rossari. Even our quarterly EBITDA, our margins are much significantly higher, between 2 to 4% compared to quarter-on-quarter last year and year-on-year last year. So we are very pleased with what has happened. We have taken care of the volatility very well. We do not have too much stocks when the raw material prices fell. So we are happy with the performance which has happened in the last 9 months.
Mr. Chari, so let's talk a bit about exports. You're saying weaker exports to US and Europe is the key reason why your revenues came in lower than anticipated and you had to cut the top line guidance. Now, exports is, I think, about 24% of your revenues, approximately.
Yes.
How much lower is the export demand on a year-on-year basis? And is that a trend which will continue? Because it's not that growth is coming back in a big way globally right now.
Yeah, so we want to increase the exports to 30% of our revenue for the next year. The plans are that Europe is picking up now, and we should see a good amount of exports for the coming financial year.
When you say exports are picking up, what is the number for the month of January and the first week of February in terms of export growth? And
we are not able to share, the current month's performance as per SEBI guidelines.
No, but is it, no, of course we do get that, but is it better? Are you seeing some improvement? And when we are talking about taking exports to higher contribution of revenues, what is FY24 looking like now? Because you've integrated all your acquisitions. You're talking about a performance which is as per your satisfaction, but still lower than what you had guided for. So what is FY24 looking like overall?
So we feel that we should do more than 450-500 crores next year exports.
Okay, that is 450 to 500 crore rupees in terms of exports, and overall margins. Will they continue to see better numbers? 13.9% right now. Are you seeing improvement across all the segments to go to previous level margins as well?
Yes. So if you see our last 3 quarters, there has been increase every quarter, and we are at 13.9% now. We are optimistic about margin improvements in the coming quarters too.
I believe you've guided for margins of 16 to 17% in the next 2 years. So
yes,
that is an improvement of 200 to 300 basis points from here on.
Our target is to reach the 16% plus mark, in the FY25.
16. How will you achieve it? What is the roadmap?
When we have increase in sales and our costs do not increase, and also the focus has been on profitable products. We have new launches planned, especially in the green and the sustainable range, and we are seeing a good traction in the international markets for more sustainable products. So our lab in R&D is focused on a lot of biosurfactants, green surfactants, products which can reduce BOD, COD, and TDS.
Mr. Chari, if you are spending more on R&D, what is the percentage what is the percentage versus the revenues? Will that number increase? And consequently, what will that do to your margins and your capex plans as well? What are they looking like for FY24?
So we are focusing on increasing R&D expense for the next year, definitely compared to the current year. As we have said that we do not do core molecule R&D. We focus on innovations in formulations to help our customers reduce either the BOD, COD and TDS or the generation of effluent or reduce overhead cost by reducing power, by reducing steam consumption, by reducing water consumption. So we see definitely higher amount of R&D expense next year.
Okay, Mr. Chari, we'll leave it at that. Thank you very much for joining in. That's Rossari Biotech. Q3 numbers were muted, hit by lower exports. That's the reason why the company has lowered the FY23 revenue and margin guidance. But they're confident that things are picking up. Exports have already started picking up. The contribution from exports will also rise to 30% versus 24%. And consequently, the company is gunning for a 15 to 16% top-line growth and EBITDA margins above 16% in the next 2 years. That's Rossari Biotech for you. The stock is a bit subdued in trade. Well, we're out of time on Midcap Radar from the entire team. Thank you for watching Mutual Fund Corner when we return.